We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is returning guest Jonathan Mergott. He's a precious metals analyst, president, and portfolio manager of the Meta C. Mergott Foundation. How are you today, Jonathan?
Doing good. Good to talk to you again, Tom.
Great to have you back. And of course, the last time I had you on was after the release of one of your articles that you write. This time, we've kind of set up a Q&A on Twitter and had listeners submit questions. So we'll get to those after kind of an interview of your most recent article. So why don't we start by talking a little bit about the main points that you raise in your article. One of the first points you bring up in the article was the FOMC meeting and why silver and gold got killed right after that a couple of weeks ago. So what happened there in your view?
Well, it's a little early to tell. I'm not entirely sure myself. However, looking back to references of the past, we had a similar situation around 2012 where they began talking about tapering and began talking about interest rate raises. And many people had been saying, oh, well, they can't raise interest rates because of the debt. If we raise interest rates, it costs so much to finance the debt that, we'd be at ridiculous numbers. And they did raise interest rates and we are at ridiculous numbers. So I don't think that that's impossible. So I think maybe markets are looking kind of at the past and gold might be looking at that and taking a few cues from that and being a little bit shaky. But at the end of the day, I think we need a little bit more time to kind of look at what is going on in the market, what investors are really thinking here. I'm not entirely certain what the exact cue they're going for right now is. But I think the theme of the day is hurry up and wait some more and see what cues are being taken and how the market reacts here.
Mm-hmm. So another interesting point that you bring up is to watch the miners as an indicator of where gold is heading. So why is it so important to watch the miners?
Yes, as I wrote, this is a lesson that I've continued to see play out in over now a decade. Repeatedly, when you see gold and the miners doing poorly, and the miners start reversing while gold might still be down and start gaining in terms of gold, you usually end up seeing a bottom. And that was a big factor for what I was looking at and seeing the reversal in the GDX and versus the metals when I called for the November 30th low and again in March. And at the same, in the inverse, when it looks like things should be breaking out and doing a lot better than they are, and that's not happening, that should definitely give you a little pause and advise some caution. And so I had made up this chart from beginning of 2011 to about the middle of 2013 as an example of what I was talking about. Now, if you were around at the time and you were invested in precious metal miners, it was an incredibly frustrating time. Because right off the bat, the gold started the year in 2011 at 1450 and the GDX was 62. Gold then, and this chart is on a percentage basis, which is why I annotated the prices at the levels there. But gold then went up about 35% over the course of the next 8 months of 2011. And we kind of went sideways for a while with the GDX. And ultimately, when gold hit 1920 in August, the GDX hit 67, which was about a 10% increase from where we started the year. So when you look at that kind of underperformance from the miners, which should have massive leverage to the gold price, especially considering the fact that at the time, most of their costs were higher than they are now. I think Goldcore was mining for about $1,300 an ounce at the time. So at $1,450, they're making $150 an ounce. At $1,900, they're making 4 times that. So you'd expect a massive outperformance there that was just not happening. So that was really kind of the first maybe little warning bell in your head as you're being incredibly frustrated at the performance of these miners. So then after gold hits 1920, you get a really sharp drop down to about 1550. And the GDX had dropped down from 67 to 50. So it's about I think it was a 20% loss in the metal and a 25% loss in the GDX, which is not out of line. That's nothing quite ridiculous. Actually, probably pretty decent performance on the way down there for them. Gold rallies back up to 1800 and the GDX rallies to 63. So you're like about 7-8% away from where it was at the high at 1920. Again, there's nothing quite unusual or alarming at that yet. Gold drops again to 1550. The GDX drops again to that support area at around 50 and holds at that same level. Again, nothing alarming here. Gold goes back up to 1800. Now the GDX only goes up to 58. So now you're talking, okay, this is about a 10% underperformance from where we were the last time we were at 1800. In the meantime, gold's just consolidating sideways and miners are selling probably at an average price of somewhere close to 1700. This should be record cash flow, record earnings. They should be going much, much higher. And for example, in 1980, gold peaked in 1980. The miners peaked in 1981 as their earnings were coming in. So over the time as they're earning a lot of money, you'd expect them to continue going higher, just even in a consolidation at these levels. And that wasn't really happening. So now we get gold drops back down to 1550. It's a third drop down to 1550. GDX just goes right through that floor of 50, down an additional 20% to 40. This should have been a very loud siren. The problem is it's very difficult and frustrating if you were an investor at the time to wrap your head around this because nothing has changed. You're still looking at everything. You're analyzing the cash flow and the earnings, and it should be stellar for these companies. Why is the GDX now? You're looking and you're going, okay, it's May of 2012. 6 months ago, or about 9 months ago, at $1,920 an ounce on gold, my gold stocks were worth over 50% more than they are now. Why on earth would I want to sell now? That just seems stupid. The market's totally wrong. These things are worth double this, and my analysis is right and the market is wrong. Mm-hmm. So then we rally up to 1800 one more time. GDX underperforms again, only going up to 55. And as you can see from the chart, then we slowly began trailing downwards on both gold and the GDX. But by the time the GDX, by the time gold had broken 1550, which was still up 12% basically from the beginning of 2011, the GDX was already down by over 30% in the same time frame. So there was something very, very wrong here. And again, as I mentioned in the article, you don't necessarily need to fully understand why. You just need to listen to what the market is telling you. Mm-hmm. CNBC spends 8 hours a day trying to tell you why the market's up 200 points today. And at the end of the day, it's just fear and greed. That's it. The buyers are willing to pay more for stocks, or the sellers are fearful and want to sell stocks at lower prices. That's really the only thing you need to know at the end of the day. You waste a lot of time worrying about the details of it while the market is moving and you're just missing out. So as much as it hurt wrap your head around the idea of selling at $40 a share when you're looking at 9 months earlier, your portfolio 50% higher when it was at 1920, and it seems like nothing has changed. If you were listening to those warning bells there and got out, you saved yourself a 70% loss from 40 over the course of the next 3 years. Something was clearly wrong, and if you took your cues and left the market, you didn't get slaughtered. But the people that stamped their feet and were convinced that they were smarter than the guys making $20 million a year because they're never wrong and they're bringing in hundreds of millions of dollars for their funds, they got trampled over.
So, Jonathan, can you look at the GDX as a good proxy, or are there individual miners that you watch instead?
I like to look at the GDX. You can look at the HUI and the XAU as well. Mm-hmm. The XAU has a higher amount of silver companies on it, so I feel like that kind of skews it a little bit, either to the upside or the downside, depending on how silver is doing at the time. But I think the GDX is a good thing to watch. It balances it better, as we saw during the correction, and I've pointed out many times before. The GDX, I think by the March low, is down 30%. Newmont Mining, which is one of the biggest weightings on the GDX, was down 20%, and Barrick was down 40%. Newmont broke to a new high. So if you were paying attention and looking solely at Newmont, you might have been a little bit overly bullish, and then it reversed back. And if you were looking at Barrick, you might have been a little bit overly bearish because it didn't really do much bouncing from the March lows and has still been underperforming a lot. So I think rounding it all out with the GDX is a good idea to look at as a proxy compared to how gold is looking, or just the GDX to the GLD.
Excellent. I'd like to move on a little bit here. So let's talk a little bit about something that gets covered from both sides a lot here in the metals industry, and that's manipulation. So how do you see manipulation in the metals markets? And if we look at your article, you say that after the gold standard was broken, they would have been able to prevent a bull market. But I've had past guests on the show say that the main way that they accomplish manipulation is in futures markets for the metals. So the futures markets weren't created until 1975, but yet we came off of the gold standard in 1971. So let's get your thoughts towards manipulation and whether you think it matters or not, like you say.
To an extent, it does. And it's definitely damage done, especially on a day-to-day basis. And especially if you're a day trader and you take the wrong side and then you get a slam down, it obviously hurts. Mm-hmm. But at the end of the day, in 2001, gold was $250 an ounce. And 10 years later, we're almost, 8 times that? So if they were able to stop, if they're manipulating the price from going up, they're not doing a good job. You can do these things. Every market is manipulated. They'll manipulate things on options expiration in order to try and get to try and do what's best for their book. And you'll see these things, ridiculous moves. And as I pointed out, like on a Sunday night, when you see 500,000 ounces dumped at 734, I can't prove sitting at my computer and go to the CFTC and go, yeah, beyond reasonable doubt, this is clearly manipulation, where they can bring it to court and prove it. But if it walks like a duck and it talks like a duck, it makes absolutely no sense that some whale would panic at an illiquid time and decide they need to dump that much gold or silver and have a horrible execution. It makes way more sense that somebody was trying to paint the tape and make it look weak so that further selling would occur that would benefit their put options, for example. But you can do this on a day-to-day basis. The effects could last from a day to a couple of weeks of weakness. But at the end of the day, if there's opportunity, if there's money to be made, that is the basis of free market capitalism. Investors are going to jump on that. They're going to, and I think a perfect example is the 2015 bottom in gold. I mean, we were just getting killed and killed and killed. It just kept going down and going down, going down. Eventually, we get to 1050 in 2015. Boom, turned on a dime, go shooting up 40% to 1450 from there. And that, I think, is a perfect example of like maybe algos and momentum traders just pushing it a little bit too much and then being overwhelmed by the demand to buy because there was opportunity there and got pushed in the other direction very, very quickly.
Excellent. So you have some thoughts on Basel III as well. We've covered this a couple times on the podcast now, and you have some interesting thoughts towards it in the article as well.
Yeah, well, the first thing to keep in mind, two things to keep in mind when you're reading through the regulation. It was written in 2009, so there's nothing new here. Anybody that it relates to read it in 2009. So if there was any effects that you were seeing in the gold market, you probably saw it then, and you're not seeing it now. As I had said before, there's Basel IV now that was written in 2014, and that's old news too. And that's going to be implemented in January 2023. But the other key point when you're reading through the regulation is the word voluntary. So there's aspects in which voluntary matters depending on what kind of institution you are, but any preparing for this has already been done. It's old news, and if you think that like it was like a snap your fingers on what is it, June 28th or whenever it was supposed to be implemented, that there was going to be a paradigm shift, I mean, you're kidding yourself. You really are. But more importantly, like this is a regulation that's designed by bankers and bureaucrats that are never going to do anything that is going to impede on the profitability and the life of their buddies, quite frankly. And we've never seen them do anything like that. So why would they? And as we're seeing now, here it's July 7th, and there's been no grand change in terms of gold. And quite frankly, I think it might have been the hype going into it that this is going to be some big event and that everybody should be incredibly bullish gold. I think left is exactly what's leaving it vulnerable to these sell-offs here. So I think that could actually explain a lot of the weakness right now. Mm-hmm.
So something else that's on everybody's minds right now as well is inflation. And you asked the question in your article, do the deflationary forces in our economy overwhelm inflation as they did in 2012? And it kind of occurred to me while I was reading this that if everybody's looking at inflation right now and making the inflation trade, being a contrarian, wouldn't you be suspicious of this?
Yes, exactly. And that's exactly what I have been. When I think, they say they don't ring a bell at the top, but they do. When Paul Tudor Jones goes on CNBC and is shouting about how he's buying everything inflation, he's not giving free advice to retail investors. He's drumming up demand in a market so that he can sell into it, because he was buying everything inflation 6 months ago. And now he wants to cash out of it. Now that the news has become fact, you want to sell the news. We've been talking about inflation, how we're going to see it. And here we are. PPI came in, 6.6%, I think, year over year was the last read last month. Okay, so this is old news now. It's already out there. Where do we go from here? Is it logical that we go to 9% inflation and the Fed instantly starts losing control, or we see it pair off a little bit? I mean, even in the 70s, inflation peaked up in the beginning of the decade and then paired off in the middle of the decade, and then the Fed lost control of it, and it really peaked up at the end of the decade. So I don't think we're going to go crazy right off the bat. A lot of this, and also have to keep in mind, there's two types of inflation. The Fed constantly keeps talking about, pent-up demand, which is implying the idea of demand pull inflation, which implies also a strong underlying economy, people wanting goods and services. So they're willing to pay more for them because the demand is overwhelming the people that can provide them. So they have to expand their businesses, and those extra costs in order to do so get pushed onto the consumer. And then you have cost push inflation, which is a perfect example of rising commodity prices. Input costs rise and margins for businesses decline, and they have to push that onto consumers. And in addition to that, because of COVID, we've seen issues with supply chain, which logically we would expect to kind of begin to ease and normalize in the future, which could alleviate some of the inflation that we're looking at this particular moment in time. So yes, when the news becomes fact, you want to sell the news. It's kind of getting to the point where when everybody's looking at it, that's the chronic contrarian in me that wants to sit there and look the other way now when everybody's looking and focusing on inflation. So what happens next?
So one of the other things you really wanted to talk about before we get into the questions here is about risk. So sometimes we can be sitting in a bit of an echo chamber where everybody's talking about the next 10 bagger and not really looking at the risks to get there. So what are your thoughts around this, Jonathan?
That's exactly a good point. Yes. And if there's one phrase we can use to describe this era and this generation of investing, it's FOMO, the fear of missing out, whether you're talking about GameStop, AMC, Bitcoin, even gold and silver. People are looking at these miners. Oh, this thing could be a 10 bagger, and they just get stars in their eyes to the moon. I could make 10 times my money. Yeah, you could also lose all of it. And so going actually back to that chart in that example. Now let's say at that point in time, when you're looking at that and gold drops down to 1550 for the third and final time, and the GDX falls through the floor, goes down an additional 20% from the 50 area it had been holding down to 40. And you're sitting there and you're rationalizing in your brain, why on earth would I want to sell my gold miners here when they were 50% higher not that long ago? And in my mind, nothing has changed. It's incredibly frustrating. It's incredibly difficult to wrap your head around. Your analysis is telling you these things should be worth twice as much, and the market's saying something different. And again, like I said, are you the smartest guy in the room, or is it maybe the guy that makes $20 million a year that might have inside information, that the SEC just is not going to do anything about it? You got to humble yourself to an extent there. There's a lot of smart people out there, and everybody, as I said, if you took Finance 101, you can do the same cash flow calculations on an Excel spreadsheet that anyone else can. It's no big deal here. So what are you missing? So let's take an example. And, I think most people that probably are following me, I don't know the exact demographics, but I don't think there's that many big whales there with, $10 million portfolios. I'm pretty sure most people they don't work in the finance industry. They might be new to gold and silver. Middle-class people, you might have $100,000 portfolio that you're investing. So let's look at an example of that based on from that point. So it's May of 2012. The GDX is at 40. Your analysis is telling you that the gold stocks should be worth double what they're selling for, and that this consolidation is just a temporary measure. And then when we're going to break out higher, and these miners are going to double, and the whole rest of the market is wrong. So let's say you have your $100,000 portfolio. You're all in on the GDX. And you're right, it goes to 80. Well, congratulations. That's fantastic. Over the course of, say, 3 years, you took a $100,000 portfolio, turned into $200,000. That's an amazing return. Congratulations. But let's take another example. Let's say now that out of that $100,000, you had 70% in the GDX, and you put 20% in the S&P, and then you put 10% in cash, just to kind of balance it out so you can sleep well at night. It makes you feel better. Well, the 70,000 doubled then and is 140,000. During that time frame from about 2012 to 2015, the S&P 500 went up by about, I think it was about 55%. So $20,000 is now $30,000. That's 170, and your 10,000 in cash hasn't changed. That's $180,000 versus $200,000 by going all in. On the upside there's a 10% difference. That's not that much different. But now let's take that same example and look at what actually happened. So from 40, if you were 100% in on a $100,000 portfolio at $40 a share, fast forward 3 years later at the low in 2015, and you lost 70% of your portfolio. So $100,000 is now $30,000. That is rough. That is very, very rough. But let's take that other example. So say you were 70% in the GDX and 20% in the S&P and 10% in cash. Well, your 70% went down to about $21,000. Your $20,000 in the S&P still went up by about 50%, which was the return on the S&P from that time. So that's $30,000. And your $10,000 in cash is still $10,000. So now you have $61,000. That's 100% more than if you were 100% in on the GDX. That's significant. So looking at the reward possibility of going all in versus having a little bit of a balance, versus the risk of being all in and what that could have done in a similar situation if something like that were to repeat. Make your own decisions, but to me, there's no question that that's just not worth it. And I think people, they just have this idea that if they have $1 in their pocket and they're not investing it and leveraging it in some way, that they're missing out. And that is just absolutely not the case. So I really want people to understand how that works in the reality of it, because I watched a lot of people lose a lot of money by being way too exposed, and also by not listening to what the market was telling them and not analyzing their analysis and seeing where they were wrong and accepting the fact that they were wrong. Looking at risk, it's just some of the warnings there of what could happen. People, I know, when I wrote in the article, a lot of people are have this mentality where they've done the math and they're like, I could invest in an index fund with a 20% bond allocation and 80% stock and make a standard 7% a year. But, I don't make that much money. And when I do the math, if I need this amount of money to retire, I'm not going anywhere near that with the amount that I can save when you compound the interest by the time I want to retire. So my only hope is to just kind of YOLO it and hope I can make 5-10 times my money and then do that and be able to be in a better place to have a good retirement and provide for my family. And okay, I've done the math too. You're not wrong. I can understand that aspect. But it's really different to say like, if I lose half my money, that's fine. Then when you're actually staring down the barrel of tens of thousands of dollars of losses, it's really, really difficult. It's the stuff that really ruins people's lives. So it's something to take into consideration that's not really talked about. Everybody wants to look at we're going to the moon and the 10-bagger idea, but nobody really highlights what happens when it goes wrong. So that's the point I wanted to make there. There's not much difference from the upside, but it could be a lot of difference to the downside.
Mm-hmm. So are you thinking about managing risk by diversifying, Jonathan? Is that the main point you're making about trying to manage risk, or just considering it?
I really kind of want to see, I'm expecting a bounce here. I think a lot of people are expecting a bounce. It's been pretty ugly, and we just dropped and have kind of been sideways. But the key, I think, really is going to be what happens when we bounce. Are we going to go into this mode where we really flushed out all the weak hands and sentiment has gotten bad? Sentiment's not great, but essentially when we start moving higher, are people going to be buying the dips, or are they going to be selling the rallies? Are we going to see pushback every time we go higher, or are we going to see investors coming in and buying every time we dip lower? And I think that's really going to give us the best clarity as to where we're going from there. Yesterday, I don't think was all that great. We saw we were up $35 on gold. Lost
peaked back up above 1,800.
Yeah. By the end of the day, I think we're only up $10. Silver went negative after a little while. I think it was like an hour into the market open. Silver went negative. Gold was up about 1.5%. The GDX opened and it was up 1.5%. So in terms of the GDX to GLD ratio, whether we're outperforming the metal, absolutely flat after a big plunge there. So there was nothing great there. Then as gold and silver started to sell off, I think the GDX was down 0.5% while gold was still positive. So it got even worse. Also, the fact that silver was up about half of what percentage-wise is what gold was up was also not a great indication there either. So it's looking very weak for the moment. That could change. I think we need a little bit more time. But yeah, I'm going to be looking for whether we start investors start selling the rallies or buying the dips. And yes, I think it's probably, I don't think it's a bad idea to diversify to begin with. I think there's not very many people that can stand the idea of holding an entire portfolio in precious metals. It's very, very difficult and very, very volatile. And I've always encouraged people to have an IRA or a 401k where they're putting money into a broad-based market fund, because even the best fund managers in the world consistently underperform the S&P 500.
Excellent. Well, Jonathan, let's move into some of the questions here. Of course, I want to thank everybody for submitting questions to us. And this is the first kind of, let's say, listener submitted question period that we've ever really had on the show. So,
cool.
So I want to thank, the first question is from my buddy Warren Smithson. So he says, because mining and commodities are cyclical, what do you allocate bigger positions to, cash flow or appreciation?
Okay, so this is a good question. And I've kind of looked at both. I have producers and I have explorers in my portfolio. And I made a point, and I mentioned this in the article to an extent. And I think this is a lesson that's kind of been at least been hitting me on the head over the course of the last year since gold peaked in August. And traditional thought process would be that if you're in a correction, you want the multi-billion-dollar companies, you want the ones that have good cash flow and that pay dividends, and that offers you protection. But at the end of the day, we've seen that a lot of those have underperformed, and some of the explorers that are continuing to add value by expanding their resource and proving gold and developing that property outside of whatever the directional price of gold and silver are doing, have really outperformed. Mm-hmm. So I think that's what's probably going to continue so long as we're at a price level that's beneficial for gold and silver producers to mine at, because they're going to be looking to buy these companies. Ultimately, they have to replace reserves. A lot of the gold majors have been burning through reserves at a faster rate than they ever have been before. So while I have both producers and I look at cash flow as well and explorers and look at the appreciation of the stock price and the asset that they have, I think at the end of the day, regardless of either of them, a very easy thing to do that would, what metrics spell buy and sell in your mining portfolio, leaders. If you're looking at a stock and it's down 20% since August, if you're looking at one that's flat since August and you're looking at one that's up 20%, look for the ones that have made new highs. You always want to buy the ones that are cheaper because you think you're getting a deal, but there's a reason why they're cheaper. And I've made the analogy that there's no like Black Friday sales on Wall Street. But actually, when you think about it, there kind of is, but it's like you go into Best Buy on Black Friday and you see like, oh, well, this TV's 40% off and this one's only 5% off. Well, clearly I want to take the deal that's 40% off. That's the better buy. Well, in reality, that TV is 40% off because it needs to be. Otherwise, they can't sell it. That one, they don't need to discount at that much. That's why it's only 5% off, because it'll sell anyway. So there's a reason why the good stocks don't dip as much as the other ones, and you should really look to that. If a company has made new highs since gold has made new highs, I think that's a pretty leading indication to follow the leaders and to hold on to those stocks or add on dips.
Excellent. So, as you said there, what metrics spell buy and sell in your portfolio? So let's say you have one of those leaders, and what would make you want to sell it or take some profit?
The first indication would be if it stops being a leader, because most of the time the fundamentals you're not going to figure out until earnings reports, until some poor news starts coming out, but you'll notice it in the market first. So that's really the first thing. And it also depends on the company. Some of these smaller explorers, they make new highs and then they retrace 40-50%. So that's not necessarily a reason to sell them. They're just volatile. That's the way they are. Mm-hmm. But if they're continuing to make new highs, that's a reason to hold. That's a reason to add on dips. When that changes, that is the first indication to start selling and de-risking. Eventually, you'll start seeing the fundamentals involved as to possibly why that's been the case too. But by that point, it's probably getting to be old news.
All right. So Eugene Lee asks, banks and those in power suppress gold and silver through the COMEX. So what if or do they suppress gold and silver through the miners? Equities are smaller and thus easier to short. Plus, they generally lead the precious metals.
I'm not entirely sure. I mean, they absolutely are suppressing the equities. I mean, you got a $200 million company. It's very easy to push it around. And this is part of the reason why we see, gold and silver stocks, they don't move unless they're moving 5% a day up or down. I'm not entirely sure it's going to have any effect on the metals prices by, say, shorting Newmont Mining. But yes, they are smaller. They're easier to short, and they absolutely do that. And they do lead the precious metals. So that could be a possibility. If metals traders are taking cues from that, I don't think that's really the case. I think ultimately, if you were trying to short some of the larger gold equities, and gold and silver were getting ready to break out, you're going to see a big move in them anyway, and the shorts are going to get eaten alive and have to cover. So I don't think that's necessarily affecting the metals prices, but it absolutely does affect the volatility in these much smaller market cap miners, especially.
Mm-hmm. Excellent point. So Catherine Jackson asks, this is the first time in history that central banks have owned as much gold as they do now. How might this change the outcome of historical trends that you're extrapolating?
That's a good question. Yes. This is, yes. And as famously at the bottom of the market, Great Britain sold all their gold. And now central banks have been continuing to buy them. So I'm not entirely sure. I don't think anyone really could answer that one yet. But at the moment in time, they're buying, and they're buying for a reason. And they're not buying. Some of them are buying stocks, but for the most part, as Ben Bernanke said, "Oh, it's tradition. That's why we hold gold." Mm-hmm. Okay, maybe that's why you think we hold gold. Why don't you ask India and China why they're doing it? Mm-hmm. It could be interesting. People have speculated that possibly there's somebody out there that's going to try and at least somewhat back a currency with gold. We will see, but for the moment in time, they are probably the biggest consumers of gold And that definitely is a tailwind for the gold market.
So S Lotmore 7 asks, Populist is never going back to a gold standard. Current squeeze is predicated on this based on never, and computers controlling everything. When do you think this reality sinks in and everyone bails?
Yeah, it got a little messy in the middle, but from the basic standpoint, okay, we're never going back to a gold standard. When do you think everybody realizes this and just bails? Okay, so first of all, for the most part, I agree. I don't think we're going back to a gold standard. And it's the same sort of idea. Why on earth they've created this wonderful system where we can leverage debt and money endlessly, and it's benefited all the people that get the first crack at it, major corporations and the banks and the rich. It's been a wonderful system for them. Why on earth would anybody want to change that when they're the ones in power to do that? And usually the argument that you hear about, well, at some point in time, when people are losing their homes and when they're starving to death and there's rioting in the streets, then they're not going to have any choice. They're going to have to address it, and they're going to have to go back to a gold standard. People are losing their homes. People are starving to death. People are rioting in the streets right now. They're not doing anything. This statistic, I think, was a little old. I read a couple of years ago, but it's like 14 million kids in America go hungry every night. If you're not doing anything, 50 million, 100 million, at what
where's the tipping point?
Exactly. At what point in time are you actually going to do something about it? They're not, because they don't care about us. It's the simple aspect of it. And I think everybody recognizes that it doesn't really matter what side of the coin you're on. It's them and it's us, and they don't care about us. But now on that point, here's an interesting story. So 10 years ago, when I was working for Jim Sinclair, he had, back in like 1973, he took out a full page article in Barron's that said something to the extent of just gold 900 by 1980. And then 1980 comes and gold's, I think we peaked at 887. So it was off by like $13. So at one point in time when we had some free time and I had the chance, I was just like, how on earth did you come up with that? I mean, please give me some insight. And I'm sure like there was proprietary secrets he didn't quite share. So he gave me like the layman's version of it. But he basically said, and he was like, well, I looked at the money supply, I looked at our debt, I looked at our liabilities, and I took the trend of it going upwards, looking into the future over the course of the next, say, 7 years or so. And I figured, okay, as this experiment goes terribly, terribly wrong, if we were to confront that fact and go back to a gold standard, what would the price of gold have to be? And came up with $900 an ounce. And I had said something like, well, nobody's audited Fort Knox and their gold reserves in like 40 years. Great Britain sold all their gold at the bottom of the market. How do we know that we didn't make the same foolish decision? And his answer was basically, it doesn't matter. The market will trade accordingly. And it did. The market traded according to what the price of gold would have had to have been. And another story on that note that he had told me, I don't think people realize how close we were at a tipping point in 1980 when inflation was 20% year over year and the price of gold was going from $100 to $200 an ounce all the way up to $900 within like a year and a half. He was telling me a story about friends that he had that were very, very wealthy businessmen that were vacationing in Europe that had millions of dollars in the bank. And they would go to get some of their money exchanged to local currency so they could go out on the town. And the money changers didn't want to take it. Regardless of the spread, they were worried about, number one, the overnight risk of the devaluation, and number two, whether or not they could get rid of it. So that is a complete loss of confidence in the currency. That is a tipping point to hyperinflation and just a complete disaster situation for the US dollar. And so the market traded accordingly as if we would go back to a gold standard, and his target of $900 an ounce was hit. So I know this has been kind of long, but the point of the matter is whether or not, and never say never, there's a possibility we absolutely could go back to a gold standard. I won't say it's impossible. I think it's highly unlikely. But if we get to that point of complete loss of confidence in the currency where the dollar is absolutely collapsing, the market will trade accordingly as if we're going back to a gold standard, because it will have to. So hopefully that answers the question.
So MG asks, what or was the silver squeeze hype earlier this year entirely counterproductive?
Another good one. Yes and no. On the one hand of things, if you believe in silver as money and as a hard asset, then by all means, I think it raised a lot of awareness. The Wall Street Silver page has been just followers have been flowing in there. There's now billboards up. I think it definitely has been a positive in terms of getting physical off of the market and people buying it and just taking it completely off the market. And that, I think, has been a positive. On the other side of things, that kind of hypiness was like very pump and dump like. And it, after a while, I remember shortly after it started, I was looking on Twitter and saw silver squeeze trending in the New York City area on Twitter. My first thought was like, yay, success. And then my second thought was like, ooh, that's like putting it on Time magazine, you know, like when Barron's is like tech stocks, it's the greatest thing ever in like the year 2000, right before the top in the NASDAQ's like kind of ominous there. So I think from that aspect, it did a little bit of damage, kind of just pushing a bit of hype and then slamming us back down and kind of taking more time for weak hands to get flushed out. It probably prolonged the consolidation in silver and the breakout that we've been waiting for. So from that aspect, I think it was probably counterproductive, yes. But from the aspect of getting people to buy physical and recognizing what's happening with the currency, I think was absolutely a good thing.
It's kind of like a point Simon Mihailovich, I believe, made on the show, is that if nothing else, cryptocurrencies have been an excellent way to educate a new generation of people against the problems with fiat currencies, right?
Yeah, and I'm not a crypto guy, and I don't want to. I think there's a lot of people that there's a few that people out there, they like both gold and silver and cryptos, and sometimes the crypto people hate the gold people and the gold people hate the crypto people. I'm all for the unity on that same similar idea and raising the awareness. Yes, I agree with that 100%. Yeah.
All right. So Ali Humbo asked, what are the dangers of being a gold or silver bug? What mistakes do we typically make? And what other sectors do you like to look at?
Oh, geez. How much time do we have? What are the dangers?
I think being in that echo chamber, as you pointed out earlier, and not considering the risks, that's a great
exactly.
point, right?
A lot of the time, especially, and I think this is the case pretty much with a lot of assets and industries, whether you're into tech stocks or crypto or gold and silver, you have a tendency to get yourself into this echo chamber, especially on places like Twitter or communities where that's all you talk about, and everybody's expecting higher prices, and you find yourself where just people are saying the exact same thing over and over again and patting themselves on the back for it, and you're not really getting any alternative analysis or another way of looking at things. So that's definitely a danger. I'm trying to find the question here.
What mistakes do we typically make, and what other sectors do you like to look at?
I've spent my entire career in the gold and silver industry. So I generally, from time to time, there's other things that I will look at and think that are good opportunities that I might pick up. But for the most part, I tried to not let the best stock pickers in the world continue to underperform the S&P. And I've said this before, you should have in an IRA or a 401k, a position in the broader market indexes. It's continued to do well and outperform stock picking. And it's a hedge against anything else that you're doing, essentially. So I'll look at some individual things in a lot of different industries and buy some individual stocks. But for the most part, I like to just look at the broader indexes and put money there. What mistakes do we typically make? I would have to say, I think one of the biggest mistakes that, and I think this is probably the case in a lot of industries too, but I've seen a lot in gold. I think you can see it a lot in crypto too, is idealism. The idea of, in Basel III was a great example that this is going to be some game changer and everything's going to be different now. Or, we're going to go back to a gold standard and gold's going to be revaluated at $20,000 an ounce one of these days. You could just wake up and it could just happen like that. These ideas that, like, sure, could it happen? Of course. But I mean, honestly, if that's your gameplay, buy a Powerball ticket. That's a better investment. It's got probably better odds. It's a lot of these ideas of I've heard tons of them, there's always something that's going to change everything. And it's just never been the case. So you really got to kind of, I think, banish those ideas and of too much idealistic to the moon kind of things, and just look objectively. Look at what metals have done in the past, and if you believe that we're in a bull market of higher highs and higher lows, then what is a realistic target? That's why my targets, after we hit a high of 2,100, my target was 2,300. Mm-hmm. I'm not saying $7,000 an ounce because I think that's unrealistic and it's idealistic. Mm-hmm. And I know that sells newsletters, but that's not honestly helping anyone.
And again, you have no newsletters to sell either.
I have no newsletters. No one's sponsoring me or paying me for any of this. So I get to say whatever I want.
Well, that kind of ties in well with this next question with Metalcorn Cassandra. They asked quite a few questions here, but we kind of covered some of them in other answers. But what would make you question your trade and whether or not you are in the right position?
A good one that Jesse Livermore said was that the best positions show a profit right off the bat. And at least in my experience, I've seen if you buy something and it immediately starts tanking, you should probably just turn around and sell it because it's not a good omen. And I don't think that's really just being superstitious. I think you got in at a bad time, and there's probably going to be more of that to come if you don't cut your losses and move away. What would make you question your trade? Basically price action. That's the number one thing. You can look at a lot of different indicators, but at the end of the day, are you continuing to move higher and make new highs and higher lows, or is it just absolutely tanking?
I think an interesting point that Rick Rule brought up when I asked him this, a similar question to this, was if the Fed started to actually raise interest rates, if they tried to start paying down debt, if they brought tapering in, if any of those things changed and would significantly change the environment that is so favorable for gold, that would make him start to question his, let's say, gold trade.
Yeah, and that's a good point. And yeah, I think somebody at one point had said something similar. I was talking to, and they're like, well, yeah, if we started to actually pay off debt, if we started to raise, and not just raise interest rates, we got to 2.25%. I mean, I'm talking raise interest rates to the point where people have an alternative to the stock market by being able to save money through other avenues, where we have interest rates that aren't, for a change, below the rate of inflation. But I'll say when you sit there and do the math and go, well, even if we theoretically had a $300 billion surplus a year, let's see, we'd only have to keep that up for 100 years. So, I mean, I don't think it's possible, but yes, no, that would definitely, quite frankly, at that point in time, I think you're already seeing gold crash at that point, because by the time they're actually raising rates and doing the things that they need to, again, markets are forward looking. They're not going to wait around till the Fed raises interest rates. In 2011, they crashed 2 years before that, 3 years before that. And years before we even stopped QE, let alone tried to taper and sell back to the market.
So Doom on Loop asked, do you think any analogs to past PM bull markets are informative? And yeah, I'll save the second half of the question for a bit here.
Yes, I think so, to an extent, but again, you have to realize that every economy is different. Nothing's ever going to be the same as it was before. History could rhyme, but it's not necessarily going to repeat exactly. And we are in a very, very interesting situation right now in terms of our economy. It's very hard. This is not your run-of-the-mill recession that we've suffered through. We can't really look. We can take cues from QE and fiscal stimulus from the financial crisis, and we can look at inflation that we're seeing, and we can relate that to the 70s and even the 40s. We can look at results after the Spanish flu pandemic back in the 20s and try and piece together this Frankenstein part by part sort of macro view, but it's not going to be a very clear indication of what exactly is going to happen. And that's where I think looking at charts really gives us some insight, because human emotion doesn't change. Human behavior has never changed. It's why the tulip bulb mania chart looks exactly like the NASDAQ bubble, looks exactly like 1929 in the stock market, looks exactly like South Sea bubble, et cetera, et cetera. And that's why these patterns, I mean, a chart is just plotting price action in a visualization. And the price action is based on two emotions of fear and greed. And those human emotions never change throughout history. So that's why in my article, I was looking at a situation of 2008, which is looking similar to where we are, the situation of 2011, which is looking similar to where we are. And looking at the idea of looking at the charts and the price action and how human emotion is and how people reacted in those situations, and trying to take that as a blueprint for what could be the case now, might be a little bit easier to analyze than some very, very complex macroeconomic things that are going on in our economy right now.
I really like the second part of his question here. He says, does the cup ever provide some insight into the shape of the handle, et cetera?
But in a cup and handle formation, I think from a textbook standpoint, the handle typically should not be less than 50% of the depth of the cup. And that's textbook. I mean, you got to keep in mind that, again, nothing's ever perfect, and you're plotting price action on a chart, and this price action is based on human emotion, and nothing's ever going to be perfect. So you can look and, one man's head and shoulders is another man's, just bullish consolidation on a move higher. And it can be hard to interpret which is which. So you really got to wait to see which side we break on. From a timing standpoint and a price standpoint, if you have, say, I'm assuming he's referring to cup and handles that we've seen in gold and silver. We've got a short-term one, I think, in silver, and then we have, if you want to go back to 1970, a very long-term one. So from a timing standpoint, yeah, the shoulder should not. I'm sorry, the handle should not be nearly as long as the time as the cup. But if you're looking from 1970 to now, that could wide amount of leeway there, and typically not more than 50% of the depth. So, again, that's textbook. You can take it with a grain of salt. Not everything plays out exactly like that, but you can still see the same similar results because it is similar to that. So a lot of with a grain of salt on those.
So Jelly88 asked, why do the miners accept price manipulation? Why don't they sue? Why don't they set up their own exchange? The industry that benefits most of fair pricing doesn't seem to care. What's up with that?
Well, two obvious answers. Number one, they're not in the business of litigation. First of all, also looking at silver miners, they just spent from 2013 until about 2018 living off of like $1 an ounce margins. They've been broke. They don't have that much money. They can hire lawyers and spend all of their cash, and they're going to go against these major financial institutions and try and sue. Also, again, we live in a country where you have to find a burden of proof. So you might know that this is obviously some games being played, but unless you can absolutely prove beyond reasonable doubt that a crime was committed, you're wasting your time and your effort. And years ago, I think Bart Chilton from who was head of the CFTC, I believe he honestly really believed that there was manipulation in gold and silver and tried to investigate that, and thought that he found enough proof that he could prove in court, and said at the end of the day, it was not going to be able to be proved as definitively guilty. And the second answer to that question is, yeah, they're in the business of pulling gold and silver out of the ground. That's what they do. They're not in the business of speculating on prices or suing people, or, as I've even advised, store some of it, take it off the market. But again, that's speculating on prices. They just want to pull it out of the ground and sell it, and keep it as simple as that.
I was just going to say, MBM Silver Squeezed asked, during times like this, should miners hold less cash and more physical metal in anticipation of higher prices? So we just hit on that as well. But Dave,
I'd love them to, but again, like, I understand when they say this is just not the business we're in, or that the cash flow is not quite at a point where that's the best decision for the company. I'd love for them to do that. I think it's a great idea, and I think they could take more silver off the market than you and I could by going to our local store and buying a few
rounds or bars.
Yeah, except like a few bars and a few buffaloes and whatnot. But I understand the reasoning behind it too as well. So
let's hit a couple more here before we wrap up quickly. Dave Gingrich asked, silver has never failed to reach an all-time high after gold has hit an all-time high. Do you fear that this time silver will not reach a new all-time high? I know I am starting to doubt it myself.
Yeah, so I was reading that question before, and I'm guessing they mean on a particular bull run, as a bull run starts, because silver hit its all-time high in 1980, and then we retested in 2011. We're still never have hit a new all-time high. So I'm assuming on each particular run, do you feel that this time silver will not reach an all-time high? I don't. It's hard to say. I know it's been really, really difficult in the market recently, but it's certainly, silver looks a lot better, I think, than gold right now. And it has been looking a lot better for quite some time. In March, we hit new lows in gold, and silver had double bottomed at 22. And then I think it bottomed at about 24 in March. And now we just hit a low somewhere in around the 25 area. So we're continuously still hitting higher lows here, despite the weakness in gold. I think I showed a chart not that long ago where if you look over the course of many, many years, you can see in these wedge-like formations that have appeared in gold where you have uptrends and then say horizontal resistance or support. It has a tendency to break horizontal resistance or support, not the uptrend. And so the resistance is sitting here at 30 and the trend line has been basically higher lows. So I think that will continue. I know it's kind of rough out there, but no, I do believe that's going to continue unless something drastically changes. And again, we just need some time to watch what the market's going to do here.
Mm-hmm. Maybe one last one here. Hypersonic 78 asked, do you see the silver market playing out as Palladium did in 2018? If so, any time frame for that?
I'm not going absolutely is possible. There's absolutely, when you look and Keith Neurmeyer has talked about this before in terms of, and he's said from an industrial standpoint, there's just not enough silver. So I think that's absolutely a possibility that it plays out similar to Palladium. Any time frame for that? I'm not going to give a time frame at the moment. I think it's a hurry up and wait and just kind of see how things go. Interestingly, I had my targets of $50 an ounce and 2,300 for gold and for some the GDX and the SILJ, and I was expecting a high in August to September, which I just said in the article. I'm going to take that one off the table for now because you don't have moves like we just made and then recover from them and hit new highs in a couple of weeks. So we probably need more time to go sideways. But interestingly, we were right before things collapsed about a month ago. We were pushing up. We had a few miners that were breaking out. Gold got up to that area of resistance just shy of 1960. Silver was pushing up into 29 area. It looked like we were really getting ready to go. And when you look at these breakouts, you have really fast movement and breakouts that occur and run over the course of basically about 6 to 8 weeks, and then it's over. So had we have started to kind of push in that direction like it was looking we were going to do, I think that would have taken us right smack into my August timeline for a high there. But we went the complete other way on that, which is why it's okay, we gotta see what the market is feeling here. So I don't think now is the time to really make any timeframes. It would literally just be pulling it out of thin air at this point. So right now, just be patient. Let's see again. Do these rallies get sold? Do the dips get bought? What is the mentality of the market here?
Do you think that there's a lot of differences, let's say, between the silver market now with as much industrial and investment demand, and if you take into consideration the supply side versus the palladium market back then was all industrial driven and had a major supply crunch? I think there's definitely there is the two-sided aspect of it where we have seen demand for bullion, and even the Treasury has said we don't have enough. We can't keep up with the demand for bullion. And when you look at industry, especially looking at the solar industry, which would need a lot of silver, so there is a two-sided aspect to that. Palladium, if my understanding of this one is correct in terms of the supply crunch aspect of things, essentially its main purpose is catalytic converters. And surprisingly, companies haven't gone back. I was expecting a lot more companies to start reverting back to platinum, which hasn't seemed to be the case. I believe a lot of this was due to supply constraints in Russia, where a lot of palladium is coming from. But that is I don't know anybody that's buying palladium bullion. It's a precious metal, but it's not one that has bullion demand. There is supply crunches there from the industrial side. I think silver definitely is ripe for that sort of situation because you have
constraints that could come from the two-sided side of it. And then again, you got to worry that even what we think is there, is it actually there? Because we see that unallocated in certain categories. We see bullion stores that don't have any supply, but sometimes they'll be happy to take your money thinking they can get it in 6 weeks. And then whether or not they can. So it's absolutely possible. I wouldn't put a time frame on it though, at this point in time.
Perfect, Jonathan. Was there any other questions that you saw that you wanted to chat about?
I think we covered. I think we covered a lot of them. There wasn't any
big
when
ones.
Will we? Yeah, no, I liked this one. When will we uncork the Dom Perignon? Well, yeah. If you already bought it, you can't return it. So whenever you want, you know, at 50 or at 15, you pick your poison.
Excellent. Well, this was a lot of fun. I want to thank everyone for submitting their questions. I want to thank you, Jonathan, for being willing to take your time and answer them. This was an interesting format. We'll see how people like it. Of course, you're on Twitter at jmergz, MERGZ 1985. We'll post the link to the article and everything in the show notes. Is there anything you want to add as we wrap up here, Jonathan?
Nothing I can think of. I appreciate you having me on. I appreciate everybody's questions. We had asked a couple times before. They decided to dump them on us last night. So that was nice of you guys. But I'm glad we got some great questions. There was a lot of great questions. I'm glad we got to talk about them. And it was great talking to you again. Thanks for having me on.
Absolutely. Thank you, Jonathan. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.